Hello, everybody. How's everybody today? How's my sound? Good. Excellent. Welcome. This is it. This is the final session. Congratulations. You've almost made it. I'm not sure, for your sake, I'm not sure how you got stuck with tax last, but there's actually a reason we're last. And there's a reason that we're having CPE Day a week later than we normally have it. And those who have been coming for many years know that generally CPE Day is 2 days after the election. But we've learned over the years that 2 days after any election for us doesn't work because oftentimes we don't know the answers, right? We don't know the results. There are still things that are up in the air. So one of the reasons that I lobbied to have this CPE Day moved is because of Election Day. I need more than 2 days to prepare when something major is going to happen. Obviously, something major happened this year with the changes that will happen in Washington, D.C. over the next year. So we moved it back, and then we started talking about, okay, when should we present this year? And I'm like, you know what? Even though we're 8 days after the election, we still may not know some things, so we should go as late as possible, just because, I mean, we might, you know, if you go back years ago, before some of you were born, there was a time where 8 days after the election, we didn't know who the president was going to be because they were still scratching off and opening envelopes in Florida. Anybody remember that craziness? I don't remember how long that took, but I mean, what a circus that was. But that was many years ago. We know now what Washington is going to look like. There are going to be significant changes in Washington. There are going to be significant changes in our tax law. The question is when? The question is what and how much? There's just so many things that are going to happen. But for a tax geek like myself, it's interesting to me and I like paying attention to it. I like learning. It's just very interesting. And I'm not saying I'm looking forward to it. I'm looking forward to some of the changes. But in a way, you know, with the complexity that's out there, hopefully it's not overly complex. Hopefully it's something that we can all follow and understand. I will say that once there is a significant package that comes through, we will most likely have a webinar if there are, you know, changes that we think are necessary with respect to a webinar. So keep an eye on www.gyf.com. We post quite a few things regarding tax law changes, and we're always trying to get in front of our clients that way. So keep paying attention. So what we have today, this is just an introduction. This is what Ryan and I are going to cover. Recent issues and developments. We're going to talk a little bit about our day-to-day lives and things that we deal with and our clients deal with on a day-to-day basis. We'll talk about proposed changes. We'll talk about expiring tax provisions. And those expiring tax provisions 8 days ago were significant. They were important. Not so important now, being that President-elect Trump saying he's just going to extend everything permanently. So we'll talk a little bit about that. Ryan's going to talk about tax policy outlook under the new administration. We'll talk about other miscellaneous tax topics, which, you know, I'm saying that's story time. That's when I'm just going to start talking about stuff that I've had to address over the last couple years with respect to tax law and what I'm dealing with my clients. And then we may get to the Federal Corporate Transparency Act. I'm not really sure. We may run out of time. If we run out of time, I will just summarize it for you. It was enacted in 2021. The due date for compliance is January 1st of 2025, which is not that far away. I will say that Congress is kicking around the idea right now of extending it, and there's bipartisan support, I think, for extending it, so we may not have to worry about it by January 1st of 2025. But if you do, you do need to pay attention to it. For the most part, legal counsel has been taking care of a lot of these filings. And basically what we've seen with our clients is many of our clients are exempt. Like GYF, we are exempt from it because we have, because of the number of employees we have. And a lot of companies are exempt. But if you're not exempt, if you're a small company, there's a chance you're not exempt. You have to pay attention to it. So if you want more information, go to our website. We have some information on our website to kind of walk you through some of the general rules. Okay, so let's kick it off. Recent compliance and audit trends. First on the list are tax notices. And the reason I have tax notices here first is because you know, we receive somewhere between 200 and 400 tax notices a year for our clients. Now, I can't tell you exactly how many clients we have, how many returns we do. I would guess somewhere in the neighborhood of around 2,000 different engagements. Now, some of those engagements might be one client with 30 returns, but we do a lot of returns. But I would guess that 10%, maybe 20% of our clients at some point during the year receive some type of correspondence, either from the federal government or the state government or local government. It is not good, it is not easy, and it is very time consuming. We do the best we can to keep up with them, but it's not unusual for us to receive 5 notices in a given week. And it could be a Pennsylvania notice for something, it could be a federal notice for payroll, it could be a federal notice for income tax, it could be one of many things. And sometimes it's just a letter from the federal government that's saying, hey, we've accepted your extension. I'm not sure why they need to send us a letter that says, we accepted your extension, but they send us a letter that says, hey, we accepted your extension. And the best part about that is I filed the extension on March 15th. My partnership return is now due on September 15th, and I get an approval letter from them on September 10th that says, hey, we approved your extension. So as part of my letter writing campaign, because sometimes I write letters to the government trying to allow them to fix their operations to become more efficient. My understanding is that President-elect Trump just hired Elon Musk to run the Department of Efficiency, which is kind of interesting. So I'm going to write a letter to Mr. Musk, and I'm going to start talking about things that I think he should fix to become more efficient. First off, let's get rid of the extensions. Why do I even have to file an extension for a partnership return when there's no tax due? Just say you're automatically extended for 6 months. Okay, what's that going to do? Well, it's going to save us a lot of time, and it's going to save you money because you don't have to pay us to file an extension. It really doesn't matter. It's going to save the IRS time and money because they're not going to have to respond to that extension approving it when they approve everyone anyway. And also, I've never had a situation throughout my 35-year career where the government sent me a notice saying, hey, we rejected your extension. It rarely, if ever, happens. And I say if ever because I haven't seen it. So, it's just not something that's really necessary. So in my letter to Mr. Musk, that's going to be number 1 on my list. So if you have any other things you would like for me to put in my letter, please let me know, because I plan on writing a letter and saying, since you have this new department, this should be pretty high on your list. And I've got several things on the tax side that I can add to that letter. Also, with respect to tax notices, how many people in here have received Pennsylvania tax notices either for themselves or for their clients? Yeah, it is incredibly painful. So several weeks ago, probably 4 or 5 weeks ago, I walked down in my kitchen. I'm on my way to go to the office, and my wife says, "Hey, I think I should do our individual tax return." I'm like, "Okay." I'm like, "Why?" She says, "Well, apparently you don't know how to do it." So we have 2 notices from the Pennsylvania Department of Revenue for our 2022 return. The first one says that they charge us $300 penalty, which they do every year. Does anybody annualize in Pennsylvania? If you annualize in Pennsylvania and pay your estimates on an annualized basis, you will get a notice 100% of the time. Every year, John and I talk about it. We get notices every year. We're not doing the calculation wrong. They just don't look at the calculation, and they hit us with a notice, and they say, pay us $300. It's almost impossible to get that fixed. You might as well just pay the $300. John, how many times have I told you to pay the $300? Many times. It's just not worth your time and effort, because it might be a 6-month excursion down the road trying to get that result. So it's not unusual to get those notices, and just understand, one, you have to deal with them. If it's not a significant number, you might just want to pay it because you might not be able to fix it either way. So the tax notices are a big deal. We receive them all the time. We address them to the extent we can. Also, when you get one of those tax notices and you try to reach out to the IRS via phone call, it's almost useless in many cases. Either they're not going to pick up the phone, or you're going to get somebody that has no idea what you're talking about and they can't answer your question. It's very difficult. So hopefully part of the Department of Efficiency is going to help us fix this. I don't know, but maybe my letter will help. Ryan, you have a little story about a similar situation. Why don't you talk about that?
Sure, not much of a story, but I'm still trying to get my head wrapped around the idea of a government efficiency department or whatever you referred to. But anyway, yeah, so as Dawn mentions, it's a complete catastrophe dealing with, one, the IRS, and two, we're lucky enough to be in the state of Pennsylvania that we have to deal with them as well. But just one of the things we've been dealing with recently, I guess since all the way back since 2020, whenever the corporation NOL carryback rules came into play, we have several clients where we carried back those losses to 2020 to get refunds. One client in particular was due a $150,000 refund. We filed that in July of 2021, I believe. We've called numerous times to the IRS, probably 20 different times, honestly. I'd say they answered about half. Sometimes when they did answer, they would say, we received it, it's in processing, okay? 30 days later, we've received it, it's in processing. 30 days later, received in processing, etc. A couple years goes by and we call again, trying to figure out what happened, when they said, well, we never received it. Okay, thanks. Try to call somebody else, because I don't know if any of you in here really are too familiar with how the IRS works, but it honestly depends on who you talk to. You can talk to someone 1 minute, they're helpful 1 out of 10 times. The other 9 out of 10 times they're not helpful at all. So, but it depends on who you talk to. Call again, well, we didn't receive it. There's no record of us ever receiving it. Sure enough, they say you have to actually go back and amend those tax years. Well, we already did the work to do this shorter version where we can get a refund, but they're saying they never got it, so we have to amend. Well, there's this other department out there called the Taxpayer Advocate Service Center, which is supposed to be an advocate for taxpayers on behalf of the IRS. Between us and one particular client, we called 10 total times, no one answered. So, more of the story is they're not helpful either. Yeah, so that's where we stand with that. There's still a resolution out there, it's just, it's not fun dealing with them at all.
So as far as the IRS is concerned, I mean, just 2 years ago with the Inflation Reduction Act of 2022, President Biden and the Congress at that point said that they were putting $80 billion into fixing the IRS, and that was supposed to be over a 10-year period. So there's $80 billion they have set aside so they can address some of the IRS issues. That includes enforcement, that includes their computer systems. Well, we know their computer systems are not good. I mean, it's probably 6 months ago I received an IRS notice for one of my clients that was for a tax year 1979 filing. 1979 filing. It's because they were updating their systems, like, hey, you didn't file a return in 1979. Now, obviously, that one was pretty easy to resolve. I wrote a letter and I just put a big question mark on it. I'm like, really? It's all you need to do in that situation, right? Somebody has to look at it. But they're, you know, with that $80 billion, they are auditing more pass-through companies. They're auditing more pass-throughs, including partnerships. I've had more partnership audits over the last 3 years than I've had over the last 30 years. Now, I will say that's only 2, but over 30 years prior to 2022, I probably had, I can't remember any partnership audits that I had. But over the last couple of years, I've had a couple, and I have one ongoing right now, which is kind of interesting. The last bullet point on here talks about PPP and ERC, and the question there is, will the IRS spend any time during an audit looking at these things? And the question is, yes, they will. The audit that I'm working on right now, which is a partnership, they got PPP money, about $2 million. And when I talked to the agent about it, and I knew when I sat down for the very first time with this agent that this agent was going to be a problem. You know, he was a really nice guy, but I knew he was going to be a problem. I just knew that he was going to bombard me with stuff. And at this point, we're at 18 IDRs. Each IDR has probably 15 to 18 questions on them. So we have provided so much information. But he asked about PPP. We got him the PPP stuff. It took us some time to get the PPP stuff because my client is in Texas. It took us a while to gather the documents. He's like, well, you know, under PPP, you're required to have these documents readily available. I'm like, well, they are readily available if you're in Texas, but they're not readily available if you're in Pennsylvania. He didn't like that response. But anyway, we got him the information, and he signed off on it pretty quick. So I think they were just looking for support that you had the information. So question, are they looking at it? They are at least checking to see if you have the information. ERC, same thing. Now, ERC is a different story. If you remember ERC, there were different ways to get ERC. ERC is the employee retention credit. There were different ways to qualify. First, you had to qualify by size. If you qualified by size, there were 2 tests you had to meet to get ERC. First one was a math test. If your receipts were 20% lower than they were 2 years ago, then you qualified. Easy math test, right? If you pass the math test, they're not going to look any further because it was clear that you should qualify. If you use one of these boutique firms that you heard on the radio all the time, said everybody, I heard one like 2 days ago. Just 2 days ago, I heard one on the radio. ERC, still out there. They're still wanting, the government wants to give you $26,000 per employee. I mean, I heard it on the radio. It has to be true. ERC is out there, and they will audit it, but if you use one of these boutique firms and you pretended or you said you were shut down according to what the boutique firm says was a shutdown, the IRS is going to dig into that. You may have some difficulty there. For my particular client, we met the math test, and I pointed it out to him. We meet the math test, showed it to him, and it ended up not being a problem. So pay attention to these letters. Make sure you're getting them to us if we are representing you. Don't panic. I would say out of every letter we receive, maybe 5% of them are absolutely correct with no changes needed. The other 95%, I'm not saying they're totally wrong, but of the other 95%, some of them don't need responses, and some of them do need responses. So you have to pay attention. Make sure you're paying attention to the tax year, like my 1979 example. Make sure you're paying attention to the name of the company and the EIN number, because it might not even be your tax notice. Dan Oberst and I just got we received a notice for one of our clients regarding the IC disc, and they're asking us why we didn't file the IC disc return. Well, my client never had an IC disc, but the company they bought the company off of like 12 years ago had an IC disc, and they're looking for an IC disc return going back 12 years. So you have to pay attention to the EIN, you have to pay attention to the name of the company, keeping in mind that sometimes the name of the company is the exact same name of the company that used to be a company that was liquidated many years ago, because I had that problem pop up not that long ago that kind of surprised me. Interestingly enough, there was 2 companies named exactly the same thing, different EIN numbers. You have to pay attention to those things. Okay, let me move on. Somewhat recent legislation, Ryan's going to talk very briefly about the Secure Act 2.0, which was passed in 2022.
All right, now that we finished bashing the IRS, I swear that was not our intent, but I think that might have just happened. Let's look at some of the recent proposed and expiring tax provisions. Somewhat recently, the Secure Act 2.0 was enacted at the end of 2022. This was part of the Consolidated Appropriations Act. And for those of us that remember the original Secure Act, I think that was 2019, if I'm not mistaken. This was essentially an expansion of that, and it dealt with retirement plans for the most part. Some of the key provisions in there, we'll cover some of the key ones that have impacted a lot of our clients. There's many more out there. We have articles on our website about it, so feel free to reference those if you wish. But some of the key provisions, it required automatic enrollment of eligible employees by 401k and 403b plan sponsors, and that was effective for plan years beginning after 2024. The other were changes to the catch-up contribution limits. Effective for 2025, there was an increase in the contribution limits. I think it was increased from about 7,500 to 10 or 11,000-ish. And then effective for 2024, for higher income earners, all catch-up contributions had to be made on a Roth basis. Also, the increase of the required minimum distribution age, that was a big one that we've been talking about for a while. And then the last point I have on here for the Secure Act 2.0 is the student loan matching. This helped employees that were still struggling between saving for retirement or paying off student loans. This rule, it allowed employers to make contributions with respect to qualified student loan payments, and that was effective for plan years beginning after December 31st, 2023.
Okay, moving on to proposed legislation, and I'm going to cover this simply because it was proposed and there's a chance that something happens here before year end. So this proposed legislation is called the Tax Relief for American Family and Workers Act, it was actually passed by the House on January 31st of 2024. Okay, so it was passed by the House. It was a bipartisan effort. You can see some of the things that were included in it, including bonus depreciation, Section 174 capitalization, 163J, and the change to the child tax credit. So this was passed by the House, but it got to the Senate and stalled in the Senate. And I think the reason it stalled in the Senate is because, one, it's an election year, and I don't think either party. I don't think one party wanted it to pass because it looked like they were giving a tax cut in a year of an election. And it would have increased the budget deficit. So it got stuck mainly for political reasons. And it got stuck there, and it's still sitting there, and the Senate hasn't approved it yet. So the question is, after the election, will it get passed? I've seen some commentators say that they think that there's a chance that it will be passed before year end. If I had to bet, if I was betting the mortgage on it, I would say it's not going to be passed. I don't think this thing gets through because I doubt that the current administration wants to pass a tax law right before year end that reduces taxes, because their stance is not to reduce these taxes. Not only does it reduce taxes, but it increases the budget deficit. So while some commentators will say, yeah, we think this is going to be passed, I don't think it's going to be passed. That's just my guess. I wouldn't bet the whole house on it, though. Maybe just part of the 401k, not the whole thing. It would be a lame duck passage by Congress and by the current administration. There are some important things. There are some important things in here, including bonus depreciation. And the Section 174. Section 174 is just a fiasco, the way that thing came out. A lot of my large clients that spend a lot of money on R&D took a beating over the last 2 years with respect to some of these differences between what you can deduct for book purposes and what you can't deduct for tax purposes. I had some of my large clients with $5 million add backs that we had to amortize over 5 years. So that's a little bit of an issue for many of my clients who have R&D. I do anticipate that at some point it's going to be kicked out. It's going to be reversed, but at this point, I wouldn't expect it in 2024, possibly in 2025. Okay, impact of the expiring 2017 Tax Cuts Jobs Act. Okay, so the way this sits right now, and this is part of President Trump's original tax package that was passed in 2017, effective for passed in 2017, effective for tax years 2018, expiring at the end of 2025. If Congress does nothing, this will expire. All of these provisions will sunset and tax rates will change. This was a taxpayer-friendly act. It was small business friendly. So if it expires, then it would be an effective tax increase, but not until 2026. So if nothing happens in Congress and they don't change this, it will automatically expire. So the question is, what happens now under a new administration where the president controls both houses of Congress? So we'll talk a little bit about that. We'll talk about some of these provisions and how important they are and what happens going forward under a new administration. There are more than 20 provisions here that are set to expire in 2025. Many of them are CPA friendly, i.e., I don't have to do as many itemized. I don't have as many clients itemizing anymore, so it's a lot easier to do the tax return. The SALT limitation is huge for us because it's $10,000 for my bigger clients. I don't have to worry about putting all these schedules together to see what kind of state taxes. So it's very taxpayer friendly and it's CPA friendly if you're doing a bunch of tax returns like we are. During the campaign, President-elect Trump talked a lot about making these items permanent, making them permanently part of their tax law. Let's assume just for a second that he can make these permanent. So you would have 6 years under the original Tax Cuts and Jobs Act and potentially another 6, 8 to 10 years under his new proposal, whatever he gets passed. So it could potentially be 16 years max of President-elect Trump's tax cuts, which would be unbelievable if you really think about it. So Ryan, why don't you talk a little bit about some of those provisions? And note that these are expiring, but they are still important for our clients.
Yeah, some of the key business provisions that, like Dawn said, are currently set to expire, but we think one way or another, they're going to either get extended, made permanent, something. 199A, this was a big deal. This is the 20% deduction for individual taxpayers owning pretty much any type of flow-through business. So any business other than a C corporation, whether partnership, S corporation, sole proprietorship, just could not be a C corporation. This was big because it effectively, at the time, whenever the top, currently still the top individual tax rate is 37%. If you remember, under the TCJA, the corporate, for C corporations, the corporate tax rate was reduced from, I think, 35% down to 21%. So at that time, corporations are paying 21%, individuals 37%. But this 199A deduction allowed for a 20% deduction on income from a qualified business. So that effectively reduced that 37% individual tax rate down to 29.6%. Made it a lot more competitive with C corporations. And again, this was pretty much for any type of flow-through business that qualified, regardless of income. Now, there were certain rules put into place for specified service businesses. Those professional service businesses were limited. Your income had to be under a certain amount for you to get that full benefit. Once it reached over a certain amount, you would be phased out, would not get that full 20% deduction, and over a certain extent after that, you would not get any of it. The bonus depreciation deduction, this was a big one as well. Prior to that, for a while, I think it was around 50%, was it 50% prior to that?
Yeah, it's been moving for many years up and down.
And under the TCJA, effective for, you'll see on this chart, from the end of 2017 through 2022 until recently, it was at 100%. So you bought qualifying fixed assets, mainly equipment, machinery, equipment, furniture, fixtures, you would be able to expense 100% of that right off the bat instead of depreciating over 5, 7, 15 years, whatever it is. That ended up phasing out. 2023, you'll see it went to 80%. Currently for 24, it's at 60% until it phases out after the end of 2026 to 0. That's where things stand now. You'll see, we talked about earlier, the Tax Relief for American Families and Workers Act that was passed in January. That proposed increasing it from after 2022 through 2026. So for those phase-out years, that proposed increasing it back to 100%. That hasn't gone through. We think there will be some type of adjustment under the new administration. We'll have to see. But this is currently where things stand. Now, even if there are no changes to bonus depreciation, there's still Section 179 that will allow you to expense those assets. There's just more limitations with that. So just got to keep an eye out for that. Two other more than important business-related provisions were the excess business loss limitations. This is currently set to expire at the end of 2025. What that did was it essentially limited the amount that a non-corporate taxpayer, the amount of a business-related loss that a non-corporate taxpayer could use to offset their taxable income. I think it was about, I forget what it was, around $300,000 for single tax filers, and it was double that amount for married filing jointly. That was the amount that, the maximum amount that they could deduct in excess of their taxable income. And then some of the three major international provisions of the TCJA are the GILTI tax rates, FDII, and BEAT. We won't get into those too much. This was mainly just help eliminate profit shifting and encourage investment in U.S. operations instead of overseas. You'll see those tax rates there on the chart. They're set to increase the higher rates once the TCJA expires. And then I will kick it over to Dawn for some individual provisions.
Yeah, so with respect to the Tax Cuts and Jobs Act, I mean, some of the things that are set to change, the increase in individual tax rates would go up. Standard deduction would revert to the old rules, which again, as a CPA, I don't like that because it just makes it much more difficult to get tax returns done. It's taxpayer friendly, and it's good for a lot of people because it definitely increased the amount of the deduction for a lot of people. Perhaps the most important thing on there, bipartisan support regarding that child tax credit. Need to get that child tax credit back up to $2,000 or $3,000, depending upon, depending upon the situation of the family. And then elimination of the SALT, the state and local tax itemized deduction. It was kind of surprising to me the President-elect Trump actually said recently that he's in favor of getting rid of that SALT limitation, which is kind of interesting because he originally put in the law that that SALT limitation was limited, that SALT deduction was limited to $10,000, mainly because the main benefit for that SALT deduction was to folks in higher income tax states like California, New York, Connecticut, and states who have very high tax rates. So it was a little surprising that not that long ago I heard him talk about getting rid of that SALT limitation. So that's interesting. It'll be interesting to see what he does in 2025 when they come out with their new tax package. The last thing I want to talk about here are estate taxes. So the estate tax, the lifetime exemption, which is right around $24 million, actually $27 million, that is set to be reduced in 2026 down to about $7 million. So it's basically being cut in half. It'll be interesting to see what happens under the new legislation, whether they allow that to go back down to $7 million. Well, I think there are three options. They allow it to go back to down to $7 million per person. They extend it, so it'll be, instead of $7 million per person, it'll be about $14 million per person, which is a lot, so it's $28 million per family. Or they completely get rid of the estate tax. And the only reason I say completely get rid of the estate tax is because back in 2017, when they were trying to get his original package through, they had eliminated the estate tax, completely eliminated the estate tax. So it'll be interesting to see what's in their new package at some point when they start talking about it in the future. I would be surprised if there was full repeal of the estate tax, just because it only affects such a small number of people, and it would be a huge hit to the budget deficit.
All right, so some of these provisions, we talked about what's going to be sunsetting. These are the key ones that do not sunset because they were essentially made permanent. 21% corporate tax rate, that's not changing as of now. That's going to stay there. The TCJA made some changes to the NOL limitations for corporate taxpayers. Historically, if you have a net operating loss in a year, you're able to fully carry that forward and offset it against your taxable income in the next year. The tax law changed that so that you could only offset up to 80% of taxable income in the following year. And then the requirement to capitalize and amortize R&D costs under Section 174. Dawn mentioned that briefly earlier. Historically, R&D costs were deductible as paid and incurred. Under the TCJA, however, you're required to capitalize and amortize those costs over 60 months for domestic R&D activities, and for non-domestic R&D activities, you had to amortize those over 180 months. The legislation that was passed by the House in January, they actually introduced allowing for an immediate deduction of those costs so that you don't have to amortize them. But again, that's still sitting out there. We don't think there's going to be any movement with that. We'll have to see what happens there.
The thing that's painful about that is there's bipartisan support in the House and the Senate to get that passed and basically eliminate it. They just couldn't shake hands and get it done. Everybody agreed that it needed to disappear. We thought it was going to disappear in 2022 when it was originally passed, and we were actually holding returns. We were holding returns until the deadline because we didn't want to file return, then make the change, and then have to amend the returns. We did that in both for 22 and 23 returns for some of our clients who had big R&D expenditures because there was such a huge add back. Good. Sorry to interrupt you.
Sorry. All right, so let's look at post-election. That's what everyone's been waiting for. So people have probably seen a lot of this in the news on what either party wanted to do with tax legislation moving forward. The new administration, probably no surprise to anyone, they want to make the TCJA provisions permanent, like we mentioned. We don't think that they're going to make them all permanent, maybe some. It's unlikely that there will be all of them made permanent, but we'll have to see. But some of the proposed business-related provisions that it would be new include lowering the corporate tax rate from 21%, lowering that again to 20%, or for lowering it again another 6% down to 15% for companies that'll move their production onshore. So either going to be down to 20% or possibly 15% for some companies. And then, like we discussed, there's a proposal to make the Section 199A 20% deduction, making that permanent. That'll be a big one because, like we said, if it's not made permanent, the individual tax rate's at 37%, even if you own a qualified business, whereas right now with that deduction, it's at 29.6%, roughly. Some of the proposed individual related provisions, these ones have really been all over the news lately. We've all heard of them. No tax on tip income, no tax on overtime income, no tax on Social Security benefits, increasing the child tax credit. I think that one, I forget who it was mentioned, possibly increasing that all the way up to $5,000. And then the elimination of the SALT limit, and they want to keep capital gains tax rates where they're at. The other thing we have on here is tariffs. While it's not really necessarily income tax related, it'll impact people significantly. The administration discussed imposing a 10% tariff on all U.S. imports, and then all the way up to 60% on Chinese imports. And then I'll kick it back to Dawn.
Yeah, it'll be interesting to see where some of these things land. Like, for example, no tax on OT income, on overtime income. I can't imagine a situation where you make $300,000 a year and you work overtime and you get paid for that overtime. I doubt that that's going to happen. My guess is there are going to be limits on the people who actually benefit from that. I love it. I think that's a great idea because a lot like you saw, and I think both parties were supporting that. Like you saw in the ads, the people who work overtime, a lot of those people could use a tax break, so it would be interesting. It'd be interesting to see if that's also exempt from payroll taxes. I'm just thinking out loud. And on tip income, I think that's a great idea also. The extension of Section 199A, that business deduction that Ryan talked about, business deduction for small businesses, doesn't only apply to small businesses, because you could have a company making $20 million a year and still qualify for 199A. If it's a big company and they pay a lot and they have a lot of payroll. But for the most part, small businesses, whether it's a Schedule C business, an accounting firm is a Schedule C, or if it's an S corporation, if it's a small business and the taxpayer has less than, I'll use 400,000, has less than $400,000 of taxable income, all companies under that limit are going to qualify for 199A. So effectively, you're getting a 20% deduction from your taxable income, which it's a big deal. I have many clients that qualify under 199A, and we've seen over the last couple of years how significant of a tax deduction that is. All right, moving on, I'm going to call this section My Stories, because this is just stuff that we deal with, just random things. So we're going to be jumping all around here. So buckle up, because here we go. So, in addition to just doing normal tax compliance, which is critically important to our clients, and dealing with IRS and Pennsylvania state tax notices, we do a lot of transactions. We're a firm that has done a lot of transactions since day one when GYF was formed in 1990. I probably have 10 transactions at some stage of being in process right now. And a lot of those transactions, I could get a call tomorrow and say, hey, we need you on this call for this. And actually it happened today. I had a call at 2 o'clock today because we have got a company we're trying to sell before the end of the year. And when you're going through that process of the due diligence, the quality of earnings, and you've got the buyer and the seller negotiating, it's not unusual to have to jump on a call and work through some of the tax consequences. So, just a couple things to talk about, stock sale versus an asset sale. If I have a company, there are many different ways I can sell the company. I can sell the stock. And when I say stock, I'm also referring to the LLC interest, or I can sell the partnership units. I can sell the legal entity, and when I sell the legal entity, everything goes with it. Or I can just sell the assets out of my company. If I just sell the assets out of my company, my company still exists. I just sold all the assets. So it's important to understand the difference between a stock sale and an asset sale. It's also important to understand that a sale of an LLC is not the same as a sale of stock for tax purposes, in most cases. It's not the same, even though for legal purposes, you sold the entity. If you sell the stock of an entity, you sold the entity. If you sell the LLC units of an entity, you sold the entity for legal purposes and you get everything. Whereas if you sell the LLC units and it's taxed as a partnership, it's taxed as if it was a sale of assets. So it's very important to understand that when you're talking about transactions and the sale of middle market companies like we work with every year. I had a client that was very close to being sold. We were planning on selling the C corporation stock. My client was a partnership, and they were selling the stock of a C corporation. And they'd negotiated for like 3 months. Everybody had done their work. And as happens a lot, when you get close, the buyer gets a little bit antsy, and it's not unusual for a week before a transaction is ready to be closed. The buyer comes back and they find, okay, we're worried about this environmental issue, so we want an escrow for $1 million. We're worried about this issue, and because of this issue, because of this environmental issue, we don't want to buy your stock anymore, we want to buy your assets. It's exactly what happened in this transaction. We were a week away from closing, and the buyer comes back and says, you know what, we don't like this environmental issue, we're going to buy the assets. We'll pay you the difference. What's the gross up needed? So my client calls me and says, hey, we did the calculation. Let's just assume it's a $20 million transaction for discussion purposes. They want to buy the assets. What's the difference in the purchase price if they buy the assets versus the stock? We did the this is the client talking. We did the calculation. We think it's $900,000. I dug into it, and it wasn't $900,000. It was about $6 million, which all of a sudden that doesn't work. Because my client would have been willing to take the haircut for the $900,000. They're not taking a haircut for $6 or $7 million. So it's important to understand. And when you're doing a calculation, when you're thinking through something like that, you have to not only think about the current year and what the tax consequences are, you have to go out from, until you actually liquidate that company, which in some cases takes 2 or 3 years. Because a lot of my deals that I'm working with or working on, they're taxed as installment sales. Instead of somebody writing me a check for $20 million when I sell my company, they're going to write me a check for $10 million, and they're going to pay the other 10 over the next 5 years. So that gets taxed as an installment sale. And a lot of things change when you're taxing something as an installment sale because you have to do the entire calculation from point 1 to point 5 years out when you receive the last payment. The next bullet point talks here about getting whipsawed on a transaction. And getting whipsawed on a transaction is a situation where you sell a company under an installment sale, you get paid over a number of years, you liquidate the company a year later, and you have a huge basis in the company when you liquidate it. When you have a huge basis in the company, you potentially have a big capital loss in year 3, and you can't offset any taxable income in year 3 because you don't have any gain left. So example, and I had this example many years ago, was guy sold his business for $3 million. The payments were $1 million in year 1, $1 million in year 2, $1 million in year 3, and for some reason there was a $30,000 payment on January 15th of the following year. Okay, so we treated it as an installment sale. You have $1 million gain, $1 million gain, $1 million gain. All those gains were taxable. And then the 4th year we have a $30,000 gain because we're going to receive $30,000. Well, the problem was we had about $1 million of basis left. So with that $1 million of basis, we had a capital loss of almost $1 million. Well, that's a horrible answer, right? Because in the 3rd year, we had $1 million of taxable gain. The 4th year, we had $1 million capital loss, and you can't offset those. So in that particular situation, I went to him, I said, listen, we need to renegotiate this. We don't want the $30,000. We're better off not getting the $30,000. We want the $1 million capital loss moved back 1 year. We had the $1 million capital gain, we offset with a $1 million capital loss, and we just reduced our taxable income by $1 million. Whereas if we would have not have done that, we would have had that carryover effect. So that's what I refer to as the whipsaw effect. When you're selling a company like that, you have to be careful in making sure you're matching up the square pegs with the square holes, right? Because sometimes you can get whipsawed. I use the term how often when we're talking about transactions.
It's unbelievable.
It's one of my favorite words, whipsawed. Say it out loud, whipsawed. It's awesome. But you kind of have to go from day one to the end of existence of the entity to put the pieces together to make sure you're not missing something.
You made that term up, correct?
I looked it up because I wanted to make sure I spelled it right here. So I looked it up. It is an actual term.
With respect to what's happening, you made it up.
So you're saying I made it up for tax purposes?
Yes.
Maybe I did. We'll go with that. I like that.
I like it.
I'm an innovator.
Yes.
Different tax treatment for federal and state purposes, similar to the installment sale. Example, some states, Pennsylvania, does not allow the installment sale on the sale of securities. That's a horrible answer when my companies have installment sales of securities, because I'm working through a transaction right now, my $20 million example, $18 million purchase price, $2 million going to be paid in 2 years. Pennsylvania wants you to recognize that $2 million now, and if it changes, they want you to back it off 2 years from now and just reverse it, right? That doesn't work in Pennsylvania, because what does Pennsylvania not allow you to do is use losses on your tax return if you don't have any other losses. So Pennsylvania is really kicking you in the backside here by not allowing you to use the installment sale reporting on day one. So whenever I have situations like this, and I had a call on Monday about this exact situation, I call my client, I say, hey, listen, I'm looking at the stock purchase agreement, it says your earnout is $2 million. What are you really going to receive? Because 9 out of 10 times that I've worked with you on transactions, your earnout tends to be either 50% of what we thought it was going to be, or it's zero. I don't want to tax this assuming you're going to receive $2 million, because it screws up my calculation, and then I either have to amend all the returns, and when you have 30 partners, the last thing you want to do is amend the returns. I either have to amend the returns, or I have to plug it in year 2, which generally gives us a really bad tax result. So call my client. Instead of using $2 million, we're going to use 1.5. If we get audited, and the IRS comes in and says, it was $2 million, why'd you use 1.5? Well, we used 1.5 because that was the right answer, because if you look at what we really received, we only received 1.3. I should have only received 1.3. So as long as I have the facts behind me, I'm not concerned about fighting the IRS over that, because ultimately we know what the answer is, because we're being audited 2 years down the road. State tax withholding requirements. This happens when you're filing in a bunch of states. If you're filing in a bunch of states, you have to withhold taxes on any shareholder or any member who's not a resident of that particular state. So if I have taxable income in Wisconsin, and I have a Pennsylvania owner who owns part of that Wisconsin company, if that Wisconsin company has taxable income, $100,000, it passes through to this Pennsylvania resident, I'm required as a company to withhold taxes from that person. If I don't withhold taxes from that person, the company ends up having to pay the tax, because the tax is due with the return. Ryan and I had a situation a couple years ago where we had a big transaction, and there was $850,000 of state taxes due to like 10 different states, and the company distributed all the cash flow before we filed the returns, and they weren't thinking it through. And because of that, we had to go to them, listen, you got to go back to your members and get $850,000 because you owe the states $850,000. So you have to think through that before it happens. Keeping us involved is very, very important. So we have a minute left, and we're going to finish on time no matter what. So do you have anything else you want to address before I address a couple of these other things?
I do not, other than that. The state tax withholding requirement, that is near and dear to my heart. Please, if you sell a company, check with us to make sure you're not distributing that cash out to the investors. Will save you so much time.
Yeah, planning for that is critically important, because the company ends up with taking the hit if they didn't withhold the taxes, right? Because it is the shareholders' responsibility. The shareholder doesn't end up with any less cash, right? Because they would have had to pay that tax anyway. You just have to help them understand it. You have to help the shareholders understand it. Generally, we put a very detailed letter together that says, hey, this is what we did, this is why we did it, you owe this tax, you have to take this credit on your tax return. And it is interesting also that not all shareholders are taxed the same, because you will have shareholders live in Pennsylvania, tax rate of 3%, and you have shareholders live in Florida, 0% tax rate. And the last comment I will make goes back to what Mike showed earlier today with respect to inheritance tax in the state of Pennsylvania. Mike didn't say it out loud, but if you have a big estate, Ryan, say it.
Don't die in Pennsylvania.
Don't die in Pennsylvania. Because you'll get hit with the inheritance tax and your heirs will not be happy. Mike didn't say it out loud, but Ryan did. Remember, during your evaluations, it was Ryan that said it, not Don. Thank you very much. First, kudos to the folks out back there doing the technology. You guys did a fantastic job. Nothing. I think we were right on time. I think Jeff is coming up, but I think we finished right on time, Ryan.
I think we did.
Last comment on the Corporate Transparency Act. Pay attention to what's going on over the next couple of weeks to see if that is due for you. But if you have a small business, a small LLC, and you're not paying attention to it, there's a very good chance you have to file. www.gyf.com if you want more information from our website.